Gosh, I am just all right. All right, so we're trading XIV and SVXY. We'll also be doing kind of a trying to do a summary of some of the things. I have a summary slide. I don't know if it's going to be enough, but we'll see. Remember, here's our disclaimer. This is for informational education purposes only. The data analysis is for informational education purposes. Trade at your own risk. Consult your financial advisor. All right. Trade from last week. Of course, when I said move this to May, if you could, not realizing UVXY had, when I looked, it didn't have any May options. Vol Master. Actually, how have we done on all these masterclass trades? I don't think we've had a loser. That's pretty good. You know, you're saying that, Michael, until it's actually, Michael, just close trades. I get bored. You just have to close trades. That's all it is. Well, once we talk about the class today too, the vol product. So anyway, this as a trade setup for what we had worked out okay. You could sell the UVXY puts for 245 or higher, and the fly has not changed a whole lot, maybe 3 or 4 cents. Right, which is kind of, you know, if the market goes sideways, this would work. So this was a trade from last week, but like I said, if you come up with ideas and you don't follow them and you don't write them down and you don't write the vols down and you don't do the work on trying to unlearn why things work, you're not going to learn anything. Because trading volatility, I think, it's just different. Okay. But right now, what you should start understanding a little bit is what drives these products are much different than probably what you see on the headline news. If you're getting anything out of this class, you should be reminded of what drives the pricing of these products. Okay? Or backwardation. It's just we don't know what that looks like anymore. I have an example here, right? The VIX futures, right? What's the index doing? What's VIX doing? What are the futures doing? And that helps you set up a trade. The way I look at the vol products. I pretty much use this way to set up a vol product trade all the time. The one thing we haven't seen so far is, you know, any kind of running vol trade. We talked about ways to do it, and we'll cover that here at the end. But, you know, if you think about it, have we really had great conditions to really have sort of a aggressive long volatility piece in the last, since we started this class, right? 9 weeks ago. Right? So if you are taking this class and you can understand that, you've picked up a major tenet. I mean, you want to own vol when it's moving higher. It can just sit here and do nothing for a long time. All right. So what we're going to do is I'll do XIV and SVXY. We'll look at SVXY. There's potentially could be something that's interesting. We'll price it. Again, I'll hopefully, kind of using a method to look at a vol product trade, you can see if it's interesting or not. So here's just a chart of XIV and VXX, right? Here's XIV going up. Okay. Here's VXX going down over a similar period of time. Right? They're pretty much the inverse of each other. Okay. Notice something though about the products. XIV has made a major move from the bottom last February, early February. Right, we could even say late March. VXX has done, besides having a couple little bursts up, and they were little bulges, right? Has basically been, volatility has been on a one-way trip down for a year. Okay. How long will that go on? I have no idea. I'm sure it'll go up at some point. Something will happen. Okay. Right? Because everybody talks, there's mean reversion in this, but there's no guarantee it's going up in the next month. You have these elections, there's some political uncertainty, right, which is kind of keeping me on the sidelines for a lot of stuff, but ultimately it hasn't made any difference at all. Right. So XIV as an inverse product, I usually think about this product when does it become an interesting trade. Because here what I'll explain is there's a lot of inherent risk in this product. Whoops. If I do this, I just want to give you this link. Yeah, there's a link. It's an ETN, so it's a note. So it has characteristics that could make it go to zero if you have, or they could stop trading it if volatility goes low enough. If you have a shock. I have not seen it happen yet. I have seen it get to very low numbers. Single digits. I haven't seen it go to zero yet, though. We just haven't had a big enough vol shock while it's been a product. Okay. My biggest thing with this particular product, just looking at the last chart, is when is it interesting to trade, right? This XIV is a lot like, the market as a whole. It will drop a lot faster than it goes up. And because it's an inverse product, it takes a while to get back to where it was on a vol shock. So the good part is it's something you could put in an IRA to be short vol, and it doesn't have an expiration. So instead of buying puts in VXX, if you can't do that, it is another way to be short vol by buying this product. There's no decay, meaning, it's like an options. It doesn't decay. It actually, as long as we're in contango, it has positive decay. I think it makes a better trade when you're falling from one zone to another, meaning kind of vol has peaked and now it's starting to go the other way. So if you've seen look at these charts that we've had, it has a tendency here, and then it kind of falls apart a little bit, and then it starts to rally again, then it falls apart, and then it rallies again. It makes a better trade if you want something that has some kick in it as far as moving aggressively when the vol's already gone down. And it's just because of the nature of what it is. It's a short volatility trade. right? So buying this product gets you short vol. So it would make sense that I might as well buy it once the vol gets really cheap, right? I'm sorry, or when the volatility gets really expensive. Okay, so trading it right now, just like, okay, I'm going to hold it day to day to day to day. You certainly can do that, but I'll just let you know there's risk in the product. It doesn't. I'll show you. It doesn't take much for it to drop 15 or 20%, and it takes a heck of a long time to get back up there when you have a drop like that. I have found in the past that using short-term calls in VXX makes a decent partial hedge. Okay, but what it ends up being is really a straddle. So if you think about it, think of XIV as just short VXX, right? It's not exactly that, but it acts very similar. So when you buy 2 calls and you sell short 100 shares of stock, what's the synthetic equivalent of that? If you buy 2 calls, if we go like, okay, if you buy 2 calls and short 100 shares of stock, right? So if I'm looking at, I got to use SPY so to make it easier, right? It's a straddle, right? So if I buy, so if you're buying 2 at the money calls, and you're shorting 100 shares of stock, right? The risk profile is essentially a straddle. It's the same thing when you buy VXX calls and sell stock. However, and this is a big however, okay? It's a very big however right now because of where the effective strike of your calls are in VXX and where your short stock is, okay? So right now, the problem is your effective calls really aren't really 238 calls. They actually would be much more out of the money than they are right now. Okay, and I'll explain how that works. Okay. So let's go to just an example. One of the last times we really had a jump in vol. And this is actually similar to a trade I had on at the time. It worked out okay. But you can get an idea of what it was. Because actually we had one bounce in XIV, which I generally like. Vol had run up a little bit. That was before that flash crash day. So you get an idea of what this is. So here's VXX at the time was trading 1762. This was on August 20, 2015. I had to dig a little, I had to go back to an old thing to find anything that was even close to relevant for this. Okay, but it gives you an idea, right? XIV was trading $43.09 and VXX was trading $17.62. Okay, not hugely different than we are now, except XIV is in the 60 handle and VXX is trading around 17 bucks, right? So actually, XIV is much more expensive. But this was the last time it was at a short-term peak. And at the time, the near-the-money SEP 18s were $1.74. Okay, so if you look at how this trades, right, by September 10th, so it's 20 days later, XIV was trading $24.68. So it had lost $19 in value, right? VXX was trading $26.68. So even if you bought the SEP 18 calls, you're up about $13.50 on 2 calls. Okay, so the idea for this trade is this. you own these calls, and the calls gained a lot of value, but they only gained $13.50 versus your loss of closer to $19 on your XIV position. Okay, so what happens is VXX calls, explode, but they don't make you enough where at the time of this trade, because you need VXX to go up a lot more. The products have become so far apart that basically your VXX calls effectively become, it almost acts like buying out of the money calls. You could buy UVXY calls, Steve. That could be another way to do it. We could look at that today. Exactly. XIV goes down disproportionately because, a 20% move in XIV versus a 20% move in VXX, right? They're two different numbers. Does that make sense? A 20% move in XIV is $8, and a 20% move in VXX at this level, it's says only $3.40. So you have to buy more contracts to make it work. Or what I think about it is you buy two VXX calls, and if you short XIV or if you buy XIV against it, it's like buying calls that are out of the money against a short stock position. So it is a short delta trade, and the only thing that calls really do for you is it gives you some protection in case XIV goes to zero, because if it does, VXX would go, it would go atmospheric in price. But don't forget, when you're looking at XIV, it's only 100 deltas, right? 100 shares. And buying two September 18 calls in this case, they weren't 100 deltas to start with, but they've each become 100 deltas, which actually gives you 200 effective deltas. So there is a point where you're actually long VXX 2 times, right? And XIV you're long only once, or short VXX only once. So it eventually becomes a long delta for volatility, but it takes a while, right? So if all that was hopelessly confusing, I hope it wasn't. But the idea is, when you're trying to hedge something or create a hedge, right? The idea for me is I want the hedge to cost as little as possible, but it creates a runner if you need to, meaning if something goes in that direction, you want it to pay. Right? The one thing about XIV is when it's down, right? And if you look at the chart, what you want to be able to do is, the whole idea is just to kind of stay in the position and then roll your calls up over time. Because what happens eventually, it's just the one-time stupids might not be so stupid. Right, it does have gamma. So, let's say your SEP 18 calls are now worth a lot of money. You sell those and you buy, more out-of-the-money calls in VXX. But also at this point, things are starting to flip, meaning XIV is a lot cheaper and VXX is more expensive. So you want to sell out your XIV call, your VXX calls. We'll go over an example. Right now it's kind of a tough example. That's why I want to use SVXY, because things are so far away. You would almost need 4 or 5 calls in VXX to create any kind of a hedge, and I'll show you an example of that. Right. So here's just looking at the product. When you look at it in a snap, what happened to it, right? It's trading $46 and it falls right out of bed. Okay. And then volatility became volatile, and it even fell apart more. Right. Moving from, almost $33 down to about 21 or 22. And I don't think it got that low again until February of 2016. That was probably the bottom. And it was the top for vol, essentially. But if you're going to buy XIV, you have to know this is a major pitfall of the product. It does not like exploding volatility, right? But if I think it, but if you look at it, it loves what we've been doing since November, right? It was in the low 30s, and it's more than doubled in price. Okay. The one time we had this little slip here, I think it traded from about $69 down to 61 or 62. VXX only was up about $1.50 or $2 during that run. It was not a lot. So the higher it gets, right, the more susceptible it is to a fall when the vol jumps, right? Because the thing is the percentage moves in VIX and the VIX futures, those percentage moves are the same. And if this product is short all those things down at very low levels, it gets hurt that much more. Okay. So here's just looking at an example, right? So what I would say is I think it's very hard to trade a short volatility position that is not capped. Meaning, if you're not trading spreads or you don't have some kind of hedge or it's not flight off or something along those lines, I think for a retail trader it's very hard because it could cost you a huge amount of money one day. Kind of, you don't want to have a one trade and done for an account. And actually, Mark is going to go over just what ugly trades are for the vol products, stuff you shouldn't do. But here, if you notice, so what I did is I shocked the vol up just a little, meaning we have our little VIX calculator or VXX calculator. I just moved the March volatility from up 2 points, the future up 2, and I moved the April future up $1.50. Okay, not enormous moves. I think right now they feel like enormous moves, but on a percentage basis, they're not huge. The March futures, that's barely, that's a little over 10%, maybe 15%, and the April futures up, a little bit more than 10%, not much. But if you look at what happens to XIV, it drops $7, right? It translates to a near 10%, to a just over 10% move for that product. So, what I want to tell you is these percentage moves here translate to big moves in XIV the higher the price goes, right? So if you're trying to hedge the product at this level, right, what do you have to actually buy to make you money? How many calls do you have to buy in VXX to make you money here? Does that make sense when I show it to you like this? Because if you see VXX for the same move in the futures, VXX will be up 17, about $1.81. Right? So on 100 shares, what do I have to buy in VXX to make that work, right? Okay. So if I'm looking at, analyze, right? So if I'm looking at VXX and I'm going a month out, let's say, right? Because let's say you want to carry it for a month because there's a lot of content. I mean, the reason why it's enticing is because when I look at this, I think XIV is decaying about what, $2 a week? Yeah, it's decaying 50 cents a day, right? So that's $2.50 a week. In 4 weeks, that's $10 higher. Okay. So on 100 shares, it's $1,000. That's not nothing. So if I'm buying VXX, okay, and let's say I'm looking at March calls, right? Or let's say, April calls at this point. We're trading right around 17. I have to buy 4 calls or almost 5 calls. Let's see now. So if I buy 4 calls and we're trading right around 1881. Okay. 1881. It would pay me about $400. It would still leave me light on my XIV position, right? Because what did our XIV position cost us? It's going to cost us around $750. I'd say $755. Okay, on that move. If we're trading 1865, I'm up 530. So I'm light 200 shares. So right, that's on a 5 lot. If you have to buy 6, 6 almost covers your move. Okay, 4 would be the absolute minimum because if you actually have a move into the 20s, right? So that's the vol products trading like 15, 16, 17, right? I'm sorry, the futures. Okay, now you're going to be a little closer, although your XIV is going to get hammered as well. So 4-to-1 is the bare minimum. Right. So when I was looking at the trade in September of 2015, 2-to-1 actually was a good cover for where the product was. It was decent. So does everybody, so what am I trying to show you is, can you see, right? So one of the things that, what makes a good trade and what makes a bad trade, I think for the vol products is, what does it cost to hedge these things? So right now, I would say a minimum, you would need at least 4 contracts, probably 5. So the cost for this product, it would eat away about half your profits. Let's see. And at 20, you would about 5 lot would catch you up. Right? So I would say it's very expensive to hedge right now versus the dollars you expect. Does everybody see that, or you have no clue what I just said? Well, that's 2. That's 2 out of 20 something. That's 3. Because remember, well, the reason why 20 is, Kurt, is because you need that many deltas. Your VXX position has to start generating a whole lot of delta, positive delta, right? Because at some point with XIV, what's going to happen? Well, it's no longer 60 anymore. Now it's down to, let's say, 45. So the effective delta of XIV doesn't change. The price gets lower. But your VXX deltas, you go from 263 to 400. So you're getting longer volatility as the market, as volatility keeps expanding. It was here. Right? XIV was 4309, and this was close to a hedge. Yeah, you know why, Doug, is because, but you at that point usually only need 1 contract because you can just keep rolling it up. Usually, though, when XIV is in the basement, the sky is falling, right? So the last thing I see people doing is rushing in and buying, shorting vol at that level. So I'll ask you, in January 2016, how much vol were you shorting and how much XIV were you buying and stuff like that? We were trading volatility back and forth. We kind of rolled one of these positions, and we didn't make any money because I just let it go when it got to about close to even. instead of just continuing to roll it, and then it would have made a lot of money. But that's ultimately what you have to do with this if you get torched on it. All right, so here's the 2-to-1 example. But what I'm showing you is it almost paid, but look what the volatility had to do to get there. Does that make sense, Michael? I mean, you had to have, you had to have a pretty giant move. But I think it makes but I think another problem too is, depending on how you trade, or maybe if you're early selling vol, you might not want to add more short vol, when volatility is toppy. Because you don't know how high vol will keep going. You're not sure. Right now, it's easy to sit back and say, oh, yeah, I'll buy some XIV at $20. But there's nothing saying it can't go to 8 or 7 or 5. And believe me, when you buy it at 30 and it goes to 20, you're going to be grumpy. Right? Because you might not have the chance to sell it out and ride a call. Or you might not have a chance to buy a call. It closed 30 one day and then it opens, 22. And the only thing you're saying is crap. So what I prefer is, if as a trade for the product, you're kind of waiting till it's already made a move down. And generally the signal for me is when the futures start to flatten a little bit. Then I'll just buy an out-of-the-money call in VXX, and I'll buy an XI and then XIV, because I think vol, and that's only when I think vol is going to start to drop finally. But it allows me time to just not have to think about it too much. Right? Because I know I'm long a VXX call, I can't get blistered too badly, and I can continue to roll the VXX call. Does that make sense? So if you were buying here, so for instance, if you said, okay, I'm going to buy these 17s, and then VXX goes to 20 or 21, right? These things will be worth like $5, right? You got to sell them, right? And then you roll up and you'll pay, $1.50 or $2 for some calls that might be $2 or $3 out of the money, because the volatility will be much higher at that point. But you won't need to buy as many of them, because this thing will be $22 and XIV will already be like $40. So you only need 3. So you keep buying. You don't need as many calls. The problem is it's taking you a while for your P&L here to catch up with what you're losing in the other position, which is why I say, instead of getting yourself into that position, wait till the vol has already sold off before you start, or the vol has already risen a lot before you start pricing it. Just because I'll just tell you, the penalty is bad on it. It is not too much. The only time I'm telling you, it's not too much trouble when vol has peaked and starts to go down, Andrew. Because the XIV will start to move. From 4 to 3 is good. And if you just wait till then, I think it's a better trade. Because the pricing makes more sense. And if you don't do it, if you do it other times, you can be right, but you're just taking a lot of there's a lot of dollar risk, and it could take a very long time to get back to where it was. So just as an example, if we had just like a small vol shock, like 16, 17 VIX, something like that, nothing huge, but enough. I mean, this product will probably be down $20, right? We just looked at its, 14, 15, and it's down $7, you're trading 16, 17, you're down double that. And now you're trading $50, and it's going to take you a damn long time to get back to 68 because it has to start recompounding the other way. I mean, it's more expensive, but you get more leverage, but you still have the same problem. I mean, my rule with UVXY in general is you just want something relatively quick to happen. Much earlier, Trevor. I'm going to say 2 or 3. And then we mention them like 3 or 4 times in a row. I can cover it here at the end. I can grab a slide and stick it in too. So, if I sat there and I dissuaded you from that, it's your money. I mean, it's been going straight up. It has massive decay right now. Like I said, in a month, it could be up $10. Right? But again, that's everything going perfectly. Remember, the theoretical decay is everything going perfectly. So SVXY is an ETF. This one, reading this, I do not believe it goes to 0. I'm 99% sure, but it can lose a heck of a lot of value. So again, it's similar to XIV. The difference is options are listed on it. And I think it's the fact that it's an ETF and not an ETN, because the other one's an exchange-traded note. So the rules are slightly different for how it does things. The reason why we cover these products is because they basically do what they're supposed to do. Meaning, once you understand how they work, they kind of work like that. Watching them, I've been watching them trade for 5 years, so they have listed options. Again, it's the same problem like XIV has. It has negative compounding in a volatile market. Okay, these products do great when volatility is doing nothing. Right, when VIX is just sitting there and the futures are just decaying away, they do great. So actually, this is the best market for these products. You're just waiting until the vol turns around. All right, and just like XIV, I like it after a big move up in VIX. Zone 4 to zone 3, zone 3 to zone 2, right, where you can actually get some lift out of it. Right. And again, just looking at how it moves, right? It moves up, slowly kind of creeping up, and then blammo, it can fall apart. Right. I think these trade a little better. I haven't put on an SVXY trade probably since, let's say, October. It's just because the last time it was really interesting to me. When it starts to move. But again, just note how it trades. It's similar to XIV. It moves quite a bit. Okay. And it has this, remember this, the volatility went up for what, like 8 days in a row or something like that right before the election? And then for the most part, it's gone straight up. So again, it was trading, 60-something bucks. Now it's trading $132. So very similar to XIV, except there's options. So one thing that I have seen in the past is, and what I want to do is lay out and see how this trade would price is, so we've got a couple things going on. You've got potential, something in France. You've got the elections. But right now, let's see if you can just make a hedge trade out of this. If it's possible for the product. Right, so let's take a look. Right, because you do have options. Right, so in this case, right, SVXY, as the vol goes down and the futures decay, SVXY goes up, right? It's very similar, right? It's minus, it has a correlation of -1 to VIX for the most part, right? All right, let's see here. I want to get. So if you're looking at this, SVXY gains about, under current conditions. Yep. Steve's saying it's just the chart's identical to XIV, it's just a different price. That's correct. But if you look at this, SVXY, okay, not too big of a surprise. It's about twice the price, right? Now that's $5 a week in upside decay. So in a month, this could be $20 higher, right? So if you look at it, you're like, wow, okay, what are they pricing a $20 move for this? Let's take a look. Because there's not a small amount of volatility in this. So if I go to, let's see here, I go to X. Okay. Just going to go to April. Okay, the volatility is 55%, which should be pretty close to the bottom of the range, just as an idea. Okay, the vol can get up there. Okay, right now I would say it's kind of on the lower end. Right, realized vol just almost like everything else because things are going straight up. Realized vol is getting torched. Okay, so just there's not a lot of volatility in the product. Okay. So we said $20 is the expected top for this. Okay. So right now they're pricing the 152 call at $2. They're pricing the 42 call at $5. Okay. Let's say, and now another thing you'll notice here is the skew is backward. Not backward, but it slopes downward because, right? Because since it's an inverse long vol product, it's a short vol product, nobody's up buying these upside calls. So call spreads price poorly in here. Okay? So the hardest part about SVXY is trying to find something that's cheap enough that might work. Because what's nice for the vol products themselves is, call flies start off not costing anything in UVXY or VXX. 1 or 2 week call flies are really cheap. You don't get that here. So even if let's say you spend, right, $8 on this call, which is a lot of money, how reasonable is it that you can hedge that call with, like, say, a SPY or SPX or anything like that? How easy is it to hedge an $8 call on this thing? Do you think it's easy to make $8 buying a SPY put? No, it's not. Even if we bought the 35-45 spread, okay, we're still spending $4. We're still spending $4 on it. So, I mean, the $4 is, I think it's semi-hedgeable. even if you bought an SPX put at this point, that's a hard one, right? Right. What SPX put are you buying that can make you $4? So do you see what I'm trying to do when I'm looking for kind of the short side hedge for these trades? I'm not doing anything overly complicated. It could. We can look. The problem is those downside puts are more expensive. Right? We could try a callback spread as well. Right? So even if I just look at April ordinary for SPX, which is the same term, okay, even going down to a 2300 put is going to cost me all the money I might make in the call. You could buy a put spread, even if you bought a, let's say 2300, 2350 put spread, still going to cost you $4. So, but now all of a sudden you're into the trade for, even on the call spread, you're into the trade for $8. What kind of a return are you making on that? It is. Well, it's expensive when you just need things. So when we look at SVXY, right, what's our outlook for the product? Part of going through the vol class is, you first price what is likely to happen given the conditions, right? It's likely that SVXY is up $15, right? The problem is, because that's what the decay is, and if you looked at the last 2 months, that's what it's done, right? So it is not out of the realm of possibility that this thing is trading 150. Okay, and I could make some money on some deltas here. The problem is it's a lot of money out there. For the type of move, for a kind of a sliding move, don't you think? For return on dollars. When you buy options, I'm trying to look for 100% on the option. Right? That's the kind of move that I'm looking for when I buy something. I'm not looking to buy an option to make like 5% on it. Right? You don't want to buy options where where you're not making a whole lot. Where the upside. So do you see why this makes that kind of difficult for this one? I thought it would be, relatively interesting for this. I mean, the only thing I could think of is you possibly could buy, some SPY put flies maybe that have a pretty long range, right? That's possible. You could buy some SPX put flies that have a bit of a range here, like this. Is it likely that SVXY will be going up? What are you basing that assumption on? Have you seen any of the previous Vol Master classes, Trevor? Okay. So the answer is, if nothing happens, if the market does what it's doing today, tomorrow, the next day, and the next day, okay, it is inevitable that SVXY will go up because the nature of the product decays every day, right? But it decays in a positive direction, right? Right around $1 per day. So it's $5 a week. So if you snap a picture and nothing happens between Monday and Friday, VIX is about where it is, okay? It's because it's a product that instead of buying the vol products, it shorts them. I'm sorry, the vol futures. It's just VXX decays negatively at 16 cents, what is it, 13 cents a day right now. So I don't think we get to the vol products until after we do VIX, so like 5 and 6 maybe. But it's the nature of those products. So that's one of the reasons why I was saying earlier in the class, if the vol futures aren't moving higher, they're moving lower. Yep. Because that's the nature of what these products own, right? SVXY is shorting this and it's shorting this. Okay? And every day that goes by, they're going to decay, right? Because they're going to eventually end up at whatever VIX monthly is. Or VIX and VIX monthly become the same thing on VIX expiration. Right? That's what they own. VXX and UVXY, they own these things. So when I look at the vol products trades, part of this course was you want to know what is a probable move for the product. And is there a way you could buy premium for less than the probable move? And then that's when I get interested in buying these options. Or if you can't buy less than the probable move, is there enough decay that makes it interesting just to buy puts in them, or to somehow short these products and kind of hedge them in the SPY or the SPX? Right? Because like I said, if vol is not going up, they're going down. So for a trade in here, I think this might be probably, I'm trying to think of, maybe we can look at, I wanted to try to price one of these. The only thing I would do is price to follow. It wouldn't be one that I was, I would be less enthused about it than I was last week for the UVXY put. Just because I keep thinking this stupid election is going to slow things down, but it's not. This one, though, if you sit and you buy calls here, let's see what we could do for a shorter term trade, though, here. Because we have 1, 2, so that's still a week. That could be $5, $6 maybe. Let's see what $6 looks like really short term. 5. Well, that's only a 4-point spread. Let's see here. Of course, it's already 8 o'clock. I don't know, you're spending $223 to make something. It's still, unfortunately, it's just not very. Is there a formula for figuring out what the theoretical VXX at the money strike is for a future month based on the? So what you're asking is there a theoretical VXX at the money strike based on where the future decays to? Or when the future jumps? Well, there's daily decay here for in this formula that shows you where you can go to. Oh, you know what's weird is they don't price that way, Steve. They don't price the underlying that way. I know, they don't. He's saying is there a forward at the money they keep decaying. They don't. Well, that's why we buy puts. You're right. I don't disagree with you. The whole problem with buying puts is when the market turns around, which is why you have to find a hedge in it. So this might be our only vol class where we really don't find, or we don't. I can show you the trade we did in our strategy letter today, which I thought was pretty decent. Which probably would be the trade I would like for our class, because I think that it works well, except for me writing it up wrong. What I don't think right now is I don't think either SVXY or XIV are a great trade. If we had kind of a market shock, it would be a different story. Does everybody kind of see the reason for that? Do you see why these things might not be great right now? I think there could be other things in them that could be interesting. Like, I could see buying a cheap put fly in SVXY. It's still we'd still need volatility to go down, but you could find cheap ones relatively if you can get it filled, but they do fill eventually. Would a VIX out of the money callback spread be better? Mark wrote those up for, I think, May. You could find 4-point or 5-point May callback spreads in VIX for not very much. I mean, here's the trade that we did in our option bit live today, which I thought was fine. Right. We bought April 17 puts for $1.40, and we paid 54 cents for the April 234, 229, 224 call fly, put fly. Right, so I can write that up as our idea here today. Now the thing is, you say, okay, Andrew, why that? Okay, so what I want to do is, okay, and I'll put that in the end. okay, is okay. What I wanted to do is, if you I wanted to do a review basically. Okay, so I tried to separate this, and what I think I'm going to do is try to set up a matrix and put it into some sort of flow chart for you guys for class 10. So you tell me what you think. So this was the order of how I would think about these things. Okay, and then you'll see we can see how we translate this to the product, to the idea we had. So the number one important thing to remember, okay, each vol product that we've covered in our class, right, uses a slightly different part of the VIX futures curve. Okay, now several of those products use the same futures but in a slightly different way, right? So VXX is not as levered as UVXY, and it's the opposite of SVXY and XAV. Okay, so they're either using a slightly different part of the curve or they're using it differently. Every VIX option uses a different future. Okay, every VIX term. So the first thing you establish is what, right? Where are we on the expiration calendar? So right now, okay, where are we? So if you want to put a trade together, where are we on the calendar? Yeah, you're close to VIX expiration, right? So March is only, we're sitting here, tomorrow will be the 15th, you've got a week to go, right? So if you want to trade VIX, you're only going to really look at the March 22 term, correct? You could look at what's there, or you could look at April, knowing that how much of VXX or UVXY is going to be all the April future, right? We're about 85% of the way there. By the end of the week, it'll be a 90-something percent. So you know that for next week, the entire week, most of the value of VXX or UVXY is going to be what? The April future. Right? So you're moving into prime time for April. Because you're just going to have more dramatic effect if April moves. Okay? So that's the first thing you set up with where you are on the calendar. You have, locally, you have the March, sort of very short-term Marches in play for VIX. Or you have a product like VXX, a vol product, where most of the product is going to be April, which means you could see a significant amount of movement in the product. They could certainly mark it down, right? If VIX cash keeps doing what it's doing, right, in a week from now, you could see a lot lower numbers for the April future, especially if VIX cash stays down here. Remember, $2 is around fair value for 30 days out. Sometimes it's a little more, sometimes it's a little less. But $2 over is about the starting point in every cycle. So there's potential for you to get decay, but also the futures start to decline a little bit into it. And so that's a potential setup, number one. So there's the calendar. Okay. Also, what's going on with realized vol? Nothing. I'd like to say there's something, but there's nothing. Because what this does is, and implied volatility overall is still at a premium. Right, so it's been like this last week. It was like this the week before. It was like this the week before. I don't know how long it's going to be like this, but it's what it is. Right. So I'm not trying to fight what's going on. I'm just trying to figure out what it is. Okay. The third thing is, where are we? Are you in contango, backwardation, or flatness? I would say we're in contango. So you're in contango, you're moving into the cycle, the end of the cycle or the beginning of the new cycle, and you have pretty steep decay on the product, the vol products. You have steep decay for VXX and UVXY. Okay, that's all known. You might not have known it before you took this class, but at least for right now, there's still pressure on those products are from the downside, not the upside. Are we up zone or down zone? Meaning, am I in zone 1 and I'm dropping? Or am I in zone 1 and I'm really rising? What would you say? You're zone 1 and kind of holding on, right? I would not say we're really rising, and I wouldn't say we're really dropping. Yep. So what that tells me is, do you really want a lot of gamma in whatever your vol product trade is? Well, you have to say something. That's the rule. Well, the thing is, you want gamma on the, you mean the bull side of volatility, Steve? You want gamma. The problem is it's not moving up though, right? VIX went up today for sure, okay? Because we have the Fed tomorrow. That for sure could be something. No question. But I don't want to see, I'm not really interested in buying gamma in a vol product until I cross a zone. Not in the vol products though, Andrew. Which vol class, how the market is pricing? 1 and 2, Trevor. Remember, we lost money because we didn't close. When you try to stretch things out, sometimes it doesn't work very good. So what I'm trying to just establish for you here is, you're just trying to look at what the market's doing to get an opinion. So VIX is definitely up today. It didn't really break out of the zone. The reason why I set the zones up is there's nothing magical about them, except as an ex-trader, I know it takes work for vol to go higher. Meaning, for VIX to climb, you need active buyers. Okay? For volatility in a product to go up, you need expansion. There has to be something to make that happen. Right? You can have small expansions, like up a little bit, back, up a little bit, back, up a little bit, back. That's just small movement. But to have true vol expansion going from zone 1 to 2 to 3 to 4 takes some work. Something's got to be happening. Okay. Well, active sell. Yeah. Okay. So what we have is, I would say today we're up a little bit for sure. VIX cash was higher. The vol products did not do very much though. There wasn't a lot of, there wasn't a ton of response from them because the futures basically just absorbed the cash move. Right. The last thing is price the slide or shock for the vol. So right now, I believe when we looked in the class today, VXX, low potential for VXX in a month was around 14 bucks. Okay. So there's something there. It's trading 17 right now for April. So if we bought a 17 put, right, our potential dollars for that, the most we could make is probably about $1.50 to $1.60 tops, right? Which is your forward pricing, Steve. Right. The reason why the vol products they don't reduce the at the money cost in the future is because there's no guarantee you're going to get the theoretical decay. That's why. You might get it 80% of the time, but it's no guarantee. So that's what we worked out. We essentially worked through this. Vol ETP options price and forward expectations of the extrinsic value. To be honest, Steve, I don't know what you mean. The UVXY expected move is evident by comparing the call put. You mean the difference in extrinsic value between the two? All right. So anyway, so what I try to do is, right, go through and see if the whole idea is, are the vol products a trade? Right. So do you see kind of how I walk through each thing we've covered in the different classes? Now, each one of these is almost loaded, by, part of the classes that we've gone through. So the idea for me is I'm trying to find a reason to trade the vol products when I think there's a little edge in them to be traded, and and express some opinion I have. One thing I've seen is when volatility is relatively high, when VIX is in zone 3 or zone 4, I think the gamma in the vol products tends to be underpriced because they're just things move everywhere. Right. We also went through intrinsic value straddles in the VIX. Even one that's not working out great is still going to break even for us. It still has a chance to make money. So when we go through this, we've just went through this, right? The opportunity in the VIX futures is really there's solid contango and we're going into the end of the calendar, right? Our risk in the position is, one, we lose the money in the VXX puts, right? And we would think we set up our put butterflies to try to pay for that. Although I always view a put fly as a partial hedge if the market falls apart. It's not a whole hedge. Okay. The creating the position is I think anyway, the money will be made in VXX puts. As soon as we're up money in those, we'll be looking to close the position and then we close our hedge. The financing part of the position should be VXX just keeps decaying away. There's no decay in the SPY. put fly that we looked at. And if all things go to plan, our VXX put should keep decaying in our favor. Okay. And lastly, manage, we just close what's working. If I'm up 250 bucks in my VXX puts, I should be able to close those and close the fly for just a tiny loss. Right? And that's working through our homework, but the homework. We're not the homework, but this will be our final trade. Right? So I have, right, we buy 5 next April 21. 21, 17 puts, 140, and we buy 5 April 21. What do? We bought the 234, 229, 224, right? Put spread. Okay. Now, what I would say, if you want a homework assignment, see if you could do something like this, or look at VIX and see if there's really anything where you feel there's any edge in the March contract. March expiring next week. Okay? And that's something you can discuss with Mark, because he's going to do the last class on selling vol products, selling premium. You look at the 14 put for 95 cents last week, or was it 13 put? I can't remember anymore, Michael. Okay. Well, for some of you others, try it again. Take a look and explain it. Not listen to these guys. Right. So I'd say here, just in summary, right? XIV performs well in dead markets, but the leverage, cuts both ways. VXX can make an effective hedge when XIV, I would say, some of the time, not most of the time. Okay. It's, again, I like SVXY when we think there's a big vol drop coming, similar to XIV. That's when I think it's worth it to buy the calls, because you really can get a run out of it, right? Okay. And the last thing I'm saying is, I've just showed you what I thought is a method that we use in Option Pit Live. Something I've taught our pro guys in our pro class, where what makes you want to trade a vol product? It's not the only answer to it. There are other ways. We do variations of this with our fund. It's done okay. We can have a core strategy, and then we'll trade just straight depending on what the edge is. I think it is. I could put that on here, right? But I think they're better that way. Basically, you want to look at these when the sky is falling. When everybody on CNN thinks the world is over, that's when you want to look at these products. Or CNBC. It doesn't mean you can't have day trades and rallies and stuff like that in them, because they really can move. But from a being able to manage point of view, that's tougher. So, if you only trade those two products once or twice a year, I think that's probably better, to be honest. All right. And Mark will show you how to sell options next week in a risk control way, and also show some blow up things. But that will do it for me for the masterclass. So hopefully you learned something. We're going to do premium selling for the next thing. Premium selling with like portfolio type hedging for like the SPY or QQQ, something like that. I might have her do one class, Michael. I'll have her do the class that says just shut up and sell the puts. I'm thinking about the giant matrix, Andrew. My biggest problem with stuff like that is we produce it and then it ends up on somebody trying to sell it on some website. It gets kind of annoying. But what the heck? Just because I like you guys. But it's probably a good exercise for me to do. Oh, you're never in the regular chat room, David. Do Mark has actually called people that have resold our stuff in foreign countries? I know, it doesn't matter. You can copyright it all you want, but you got to get a lawyer to make him take it down, all that stuff. I have to think of how the matrix would look, because it's not like I can just give you, the red pill or the blue pill or something, as far as matrix goes. But well, hopefully that's good. Well, part of the idea is really to make you. I want you to effectively evaluate where the vol is, right? Where things are. The next masterclass will be, I think, it'll be selling premium. Selling options, techniques for selling options, trying to hedge short options. So, well, I like the idea of you being legally retired, Steve. No. All right. Well, hopefully we'll give you guys a good matrix. Keep it to yourself. If it comes out, don't give it to anybody, unless you really like them. Oh, wow. Well, 10 to 1. That's a lot.